This recording? All right. I'm live on video. So I want to do a quick one because it keeps coming up. Like it keeps coming up twice yesterday, and I think it's really important. I have people that call me and they go, Kris, I've been approved for an FHA loan for $450,000, but the lender that I'm talking to won't help me buy this manufactured home that's in a park. Then, of course, I go through the first few questions, okay, not in a park, because sometimes, you gotta understand, a lot of lenders that don't do manufactured homes, they don't understand that you can do FHA, you can do VA, you can do conventional loans, even USDA on manufactured homes as long as they meet the three wickets. If you follow me, you understand what these three wickets are. June 15th, 1976 or newer, that's the date of the home. It has to be permanently affixed on land that you own. And when I say permanently affixed, because I've had people argue with it, well, it's on concrete. But is it legally permanently affixed? In the state of California, it's a 433A certification. In other states, it is going to be an engineering report that says very clearly that it's permanently affixed to land that you own. So those are the first three things. They have to meet those three prerequisites. If they do, then you could do FHA, VA, or conventional loans. If they don't, so now you're moving it to a park for one reason or another, it doesn't meet one of those three wickets. Let's just keep it simple and say, well, it's land leased, okay? So you're moving it to a park that's land leased, because there are parks where you own the land and there's an HOA. That's important. Then you can use an FHA loan. But this individual says $450,000, and what he's expecting was a one-for-one swap. I got approved over here for $450,000. I want to buy a Chattel Loan approval for $450,000. The answer to that, or it's not an answer, the statement is no. Right? So we're just going to cut right to it. Here's how it's going to go down. No, you're not getting it. Why? There's multiple things. Chattel's just a different type of loan product. Just like in FHA, whatever you're approved for on an FHA isn't going to be the same for conventional, isn't going to be the same for USDA, is not going to be the same for a VA. Every loan product is a different loan product. It just is what it is. Chattel as well as the same situation. Okay? So here's what you have going against you when you talk about a Chattel loan in comparison to an FHA loan. The interest rate is always going to be higher. Well, that's messed up. No, it's not. You got to look at it from the bank's perspective. And I say this over and over and over because everybody is just like, what about me? Let's talk about you. Do you have the cash to buy this house out of pocket? If the answer is no, then you're borrowing money from somebody. Okay? No different than if a family member came to you or a friend came to you. If you had the money to lend them, and we'll keep it at something simple, I'm going to let you borrow $1,000. If there's an expectation that you're making money, that's how you make a living, is by letting people borrow $1,000 and then you get a return on it. There are certain things that you would say is low risk to no risk to medium risk to high risk. If it's low risk to no risk, you typically would charge less because, hey, I'm going to let this person borrow $1,000. They're going to give it back to me next week. I'm going to make a little bit of money, and it went in, it went out. It's super easy. There's no risk to it. I'll make my money back. If they're not going to default. Now, meaning they have the ability to repay it and they're going to repay it, right? Now let's talk about high risk. Oh, well, they want to take the $1,000. They're going to go down to the local Circle K and put it on a lottery ticket. They're going to put it on a lottery ticket, and that's how they're going to get me my money back. Do you consider that low risk or high risk? I consider that high risk. I'm going to help you out. It's high risk. Therefore, I'm going to charge more. I want to make sure they have the ability to repay that debt. So if they lose the full $1,000 and they don't get the hitting, they don't hit, they could still pay me back, but it's going to cost them more freaking money because it's high risk. Well, guess what? There's certain things that are high-risk loans when it comes to real estate. Land is one of those super high-risk loans. I tell people put a cape on it because it's going to fly away. It is a super high risk. Land is a super high-risk loan. Chattel loans are also a high-risk loan. Here's why. You own the house, but one of those three wickets is missing. I own a house, but it's not on land that I own. Well, what happens if the person that owns the land feels away? I own a house, but it's pre-1976, so it's a mobile home. It's a depreciating asset. It's going to lose value and fall apart. It's prior to HUD codes and regulations. I own a house, but it's not permanently affixed to land, so it just can roll away on wheels. Okay, well, those are all bad things. Those are risky things. And the bank views that as risky, and therefore the way that the bank deals with risk is either with down payment or interest rate. Down payment or interest rate is what offsets risk. Period. That's what it is. Just accept that as truth. You could try to argue it, but that's real. That's what it is. So when you talk about a chattel loan, it's going to be 5% down. To me, I always tell people this is like the only non-negotiable. You can't get around the 5% down. It's going to be 5% down. So for every $100,000, it's going to be $5,000 that you have to put down. When you talk about FHA, typically the lowest down is, and the key word, let me rephrase, it's the lowest down, right? Is 3.5% on an FHA loan. So for every $100,000, it's $3,500 that they got to put down. So if you look at a chattel from $450,000 to FHA to $450,000 to a chattel, there's more of a down payment. You got to pay a little bit more, right? Next one, interest rates. I always tell people at a minimum, just accept that whatever the going rate is. So like let's talk about going rate right now, which is super freaking ugly. If you guys didn't know, we're back in it with Iran, right? And if you follow me anywhere else on social media, you see I do daily updates every day on where the rates are and what's going on in the stock market. Right now, the going rate right now, 30-year fixed is 6.63%. So I tell people just add 1 to 2 percentage points on the going rate. So 7.63 to 8.63. And I'm telling you, that's probably on the low end sometimes, depending on the lender that you're using. I don't know if I want to go deep in the weeds on this. So every person that brokers a deal, because there's only a few banks that do chattel loans, first off. Every MLO, mortgage loan originator, like myself, we usually just say the lender, right? They broker a deal with each one of these banks, or they broker through a third party. Depending on what deal they broker with that bank and how they structure it, it's going to dictate how the interest rates shake out. If they're going through a third party because they can't broker a deal directly with that bank, the interest rate, it just expect it's going to be much higher than that. Think 3 to 4 percentage points over the going rate. If they broker a deal with that bank and they don't do borrower paid, then you're going to expect that it's going to be higher. The cheapest way to do it is if you find a broker. I'm giving you guys like all the freaking nuggets right now, the secrets. If you talk to a lender or a mortgage loan originator, somebody like me, and they do manufactured home loans, ask them, and hell, this would work for you for any type of a loan. Is it borrower paid or is it going to be broker paid? Okay, so borrower paid, you, the person that's borrowing the money, if you pay me and I brokered a deal with that bank, it's going to be cheaper for you when it comes to the rate. The rate is going to be cheaper for you, almost always. And this is on every type of a loan. FHA, VA, conventional, it's almost always going to be cheaper. Nobody talks about that because typically they say, hey, this is what your interest rate is going to be. And you're like, oh, I love that interest rate. And the bank is paying them. What ends up happening is that lender will dictate what they want the bank to pay them, and that's going to output your interest rate, which is going to be higher if you negotiated with them to go on par and just pay them yourself out of pocket. So for me, and I'm going to explain to you why I do it. We brokered a deal, to where it's borrower paid. The reason why is 5% down is non-negotiable. Okay, the interest rate is going to be 1 to 2 percentage points over the going rate, and then we could roll all closing costs into the loan. Not only that, but sometimes with manufactured homes, most of the time, you can actually borrow money against the closing cost to buy down your rate. You can actually buy down your rate with that money, and it'll make your monthly payment cheaper by borrowing the money from the bank and rolling that into your loan, which is wild, but it is what it is. Anyways, I feel like I got way off track here. I usually do. I'm now at freaking 9 minutes already. So, long story short, the reason why a $450,000 loan FHA doesn't convert same dollar for dollar to a $450,000 loan on a chattel, A, down payment. B, interest rate. It's going to be significantly more because it's a higher risk loan. But here's the last one. People don't take this in consideration. They really should. But the truth is that there's a land lease. That land lease murders your debt to income ratio. Just freaking wrecks it. So a lot of people are like, okay, just tell me what the principal, interest, tax, and insurance is on the loan for the house. Okay, here's what it is. And also, you have to pay $1,000 a month for a land lease. $1,000 a month for a land lease. So you got principal, interest, taxes, and also insurance, plus the land lease. So how manufacturers typically work is you're going to have, if you find a cheaper manufactured home, it's going to have a higher land lease. If you have a lower land lease, you're going to have a more expensive manufactured home. It's like a teeter-totter. I look ridiculous doing that on camera, but that's really what it is. It's one or the other. It's rare when you see a cheap house with a cheap land lease. Very rare, very, very, very rare. So you're going to eat it one way or the other, but that's why 450 is not 450 when you talk about buying a manufactured home in a park or a manufactured home that's missing one of those three wickets. So yeah, just wrap your head around it. If you got pre-approved for an FHA, VA, or conventional loan, and you are looking to get pre-approved for some type of a chattel loan, a manufactured home loan specific, that's a chattel loan. Just because you have an approval on a different thing doesn't mean that's going to be the approval on what you're getting. Be prepared for it. I gave you the reasons why, and that's all I got. If you get bored and you're like, man, this guy his videos make me so sleepy, and you don't sleep well, watch more of my videos. If you have questions, though, just give me a call. You can look down below, whether it's on Facebook or this will be on YouTube as well, and probably LinkedIn and Instagram. But do me a favor, just freaking call me. Call me, shoot me an email, shoot me a text. I don't care, whatever. Ask me questions. That's what I'm here for. Appreciate y'all. All right, get out there and do great things.